want to show you some charts from our recent publications that compare the behavior of several different groups of investors. And the purpose here is to see if we can draw some conclusions about the current market environment based on how these different groups of investors are behaving. So let's just jump right in with this chart. Okay, bottom graph here shows total premiums paid on small trader call option purchases. So here we're looking at the little guys, right? 10 contracts or less, and we're looking at buys to open call options. So it's essentially the little guys making bullish bets on the market. And the red arrows here are important. These premiums tend to spike near major reversals in the S&P. It happened in 2000. It happened again in 2007. Those declines were plus 50% in the S&P. It happened again in early 2018. That was the start of an 18% decline. And it's happening again now, almost 45 billion in call option premiums from January 11 through January 29. That is an insane record. It dwarfs anything we have seen in 20 years. And just keep that in the back of your mind as we look at the next two charts. So that's one group of investors, small-time traders. Okay, let's look at another group. Let's look at foreign buyers of U.S. equities. This is another interesting group. I'm putting up a quote here from the Elliott Wave Financial Forecast. It reads, "Foreigners make their biggest commitments when major trends are about to reverse." That quote was from back in September 2000, and it built off of an observation that Bob Prechter made in the mid-1990s. Prechter noticed that for decades, heavy foreign buying in the U.S. stock market had served as this indicator of a major top. But you don't take our word for it, right? Look at this chart of the S&P plotted against foreign investment in U.S. equities, right? The red arrows, again, are important because we see the same profile, right? Strong foreign interest at the reversal in 2000, once again in 2007, and here we are in late 2020 with foreign buying just blowing past all prior records, right? For most people, this is a complete mystery, but these two charts are a great example of how knowledge of Elliott waves can be used to make sense of market data. These charts are entirely appropriate from our perspective because the wave structure indicates that we are dealing with a higher degree peak than in 2000 or 2007. Okay, now let's just take a look at one group of investors who have entirely failed to embrace this market rally. Take a look at this chart. It's from the Washington Service. It tracks insider buys and sells, right? Here we see that corporate insiders, over the first 2 weeks of January, corporate insiders sold nearly 8 times as many shares as they purchased, right? That ratio, the sell to buy ratio, is easily more extreme now than at any time since 1990. So the insiders, they won out. That's what the chart shows. We may never know exactly why they won out, but whatever their reasons, they are behaving exactly opposite to small traders and foreign buyers. And those groups, as we know, tend to be on the wrong side of the market at the most important turns. So these three charts, when you view them independently, they make no sense. If we put them together, view them together, this interesting picture of complacency or amateur trading emerges. But what's really important is when we put these charts together with Elliott wave structures, and that's what we do all the time in our newsletters. When we add that component, all of this really starts to make sense because, again, we're dealing with a larger degree top today than we dealt with in 2000 and 2007.